One, welcome MMTs. What do we have? A NFLX 185 call option. Oh my goodness. What we are going to show you is that this call option right here on Friday's expiration, the high of the contract was $17.80, and they took that down to that very low. So they went from an inflated price back down to the deflated area. What we want MMTs to know is they took $7.55 ratio out of the inflated call. That negative 7.55 ratio is where we like to start looking at buying, because they're taking more out of the call. The same 185 put right here, we know that they gave a $6 ratio. So the low was 8.15 and the high was 14.13. So from the low to the high, so right here to there was a $6 ratio, debit ratio in the option premium price on the put side. Now, they took $7.55 out of here, but they only gave back $6 here. There's a $1.55 difference. They're stealing more out of the call side and giving less to the put side. So when we get wholesale entries, we know to be a seller quicker. And also we know that the amount of money that they're taking out of this side of the market is that we can put a drop down bid. So if they're stealing more out of here, what we would do is we would take this 185 call, we will put it into a level 2, and the thing about it is we would start lining the lower market, because they could still come down to the 920 by 950 market. And if we take the closing price at 1075 and we back out the same amount that they were stealing here, $1.55 below 1075, that's going to give us an entry price. So let's do the math. 10.75 minus 1.55 is what they're stealing. So you subtract that and you come up, without even me doing that, you come up to a market of 920, and bid would be 920 and ask would be 950. Okay, so basically by taking out that ratio, we know by limit order out there at 920 that they're stealing the premium out of the call to the deflated price where they could be bought. Remember, all MMTs are taught about inflated goes down. That was inflated. That meant that when that was inflated, that meant that this put option that used to be over 20, this put option right here used to be $20.60. It got down to $8.15. They took $8 of premium out. And basically, when you get inflated premium up here, you buy this side of the market first, because it's going to reinflate. As it's deflating, we're reinflating. And basically, we take the upside profit out of here, because eventually we're going to hit the deflated call and we're going to buy that call. So we own the call wholesale, but we already own this wholesale. So if we're $6 up on this and we're buying below the market here, we can let this side run. Once we lock in the wholesale price here against our wholesale entry here, we are in a perfect paradise world. As far as squaring off wholesale to wholesale to 185 put wholesale, we already got. This is going to come down to wholesale and we'll buy that. Now, whenever Netflix wants to do its trend, which is going to be right here on this daily chart, this daily chart is a big reversal, man. And this is $1.95 per half delta line. So we know by looking over here at 1075 and 1090, if they drop down a half delta, or a full delta is going to be $3.85 or something like that. That would inflate the call or deflate the call more to our entry and inflate the put. So the idea as you move forward through 2011 is getting this, when this is up here and we start to reverse, you want to be buying the put option. Okay? And once you get down to where we stop and we turn around to get ready to bounce, that's when you want to buy the call option wholesale. All right. And basically, that's the 185 call and the 185 put. So if I'm buying way down here at the bottom and I'm already in over here at the bottom, I'm way up here and I'm way down there, I can buy that deflated call against the value of my inflated put that will get inflated. And if something starts to change, I take my profit here and I'll let the call side run. But I'm getting wholesale against my gain that I got on the 185 put. So I'm up here, let's say I do go to $16 and this comes down to 750 by 775. I'm buying that there and I'm inflated. Maybe that goes higher. I'm already making enough money on this side of the trade. And I'm buying wholesale against my inflated value of that 185 put. When I have to cash out, I cash out and then I would let this side run and add to it because I'm buying wholesale on this cycle. And the actual chart of NFLX will be the deciding factor, and that's going to be this daily chart. And we got support levels at various different places in the market maker brain. Right now, this half bar is 184.77. This half bar over here on 110 of 2011 was 183.57. Well, I'm sorry, but NFLX closed below that price of 182.09. So it still has a negative ratio, which means that that supports the higher put prices until it stops. Once it stops and we reverse, so we don't have this bar right here, we're below that one. And basically this half bar over here where we had a bottom is at 177.19. Half of that bar is 177.67, and the hook bar is 178.47 half bar. And we're sure coming in that direction down here, which would also take the call premium lower. So we start looking at $9.20 if that's the case, $8.60. We start getting below the market because that means if that goes up in value, then this put option, this 185 put, is going to continue to rise in value. But we know that they're still in premium. They're not given nearly the dollar premium back as they're taken out of the 185 call. And this is a market maker level in the options. That's not the stuff you read on the internet. No, 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 no. Wholesale to wholesale, and then the individual trend itself will be the deciding factor as how far we start to break down here. Or we could come, if we gap up and sell off, then the call would reinflate and that put value would come down. So depending on what happens in the trend, we'd be executing both at 185 versus 185 for now. And that the daily trend is going to benchmark where that wholesale bid is. I'm just saying that NFLX is in a reversal. It had its reversal here, and its volatility had reversal here, reversal 1, reversal 2, reversal 3. Now we started a fourth reversal back up here. And the disturbing part is that this half bar is at 195.24, and that was on 12.10. And that's the upside. That's where that last resistance. Half of this bar is 187.56, this one right here. And that bar is on 12.13. And we closed at 182. So you can see you're $5 below this half bar over there. So any move up, that major bar is going to be part of the catalyst. Until you can close above this, 183.57, this is where the bigger part of the breakout. You got to get back and hold support above that half bar. Now, each half delta line is $1.95. 1, 2, 3, 4, 5, 6, 7 of those down. 7 times 2 is $14. Well, this one's $10, but if you have that much. So we're looking at the daily reversal. When the weakness comes out of the daily reversal, then we'll buy the deflated call. And then we would let that go higher. So basically we'd let the call price go higher from down here back up. And then the put price, MMTs, would go from just like here, go back down in value. And so it just depends on how this trade works out. Doesn't matter. We're ready to move in at each one of the points. So you come up, you take off, this would reverse. But there's a lot of room to the upside here. And basically $6 move up here on the put side of the market, So when you fall below, down toward the 185 and below it, you get premium. The 185 call that was in the money, they tranched it. It was retail over here at the highs, and now we're getting in. Starting to get down to where the last wholesale area was. That on this weekly chart, you bought in down here, and you popped it out up here at the high. That's a big money. And we're coming back down, and we'll find out where the wholesale range is on NFLX options trading.